from Bloomberg's world headquarters in New York City, I'm Matt Miller.
And from our studios in Washington, D.C., I'm Caitlin Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance. Coming up, another week, another hearing. While lawmakers pick apart bank failures, a new Chicago Fed report shows how big investors drove the run on crypto platforms last year. We'll discuss with Nic Carter of Castle Island Ventures.
And Solana's grand ambitions for mainstream adoption of Web3. Co-founder Raj Gokal discusses the blockchain's growing ecosystem that now includes an Android phone.
And a review of governance practices at 60 of crypto's most influential companies found many lack guardrails to avoid another round of scandals. We'll have the details on that Bloomberg exclusive. So all of that is ahead. But first, let's get a snapshot of today's market action. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is it's a relatively muted, though mostly lower day for some of these digital tokens. Bitcoin down about 1%. We are trading just above the $27,000 level, whereas Ether has been kind of fluctuating, teetering right on the edge of gains and losses. It is literally unchanged at the moment at 1826. You've got Solana, one of the underperformers today, down about 1.8%, trading at just under $21. We're going to have more on Solana in particular, as Matt mentioned later on in the show. Looking forward to that conversation. And Litecoin actually an outperformer on the day. It's higher by about 3 percentage points, Matt.
Yeah, very much looking forward to talking about Solana. For now, in terms of really the plain vanilla assets, Bitcoin is an outperformer. This is a year-to-date chart, and though Bitcoin has underperformed this month, if you look at the history of 2023 so far, it's stomping other assets. Much a bigger gain than Ether, and really, 4 times what we see in terms of the NASDAQ, the S&P, the U.S. Ag, that's a bond index, and in terms of gold, it's up only 10% year to date, keeps bouncing off that 2050 level, and Bitcoin is up at $27,000. Some high-profile firms are stepping back, though, from the crypto industry here in the United States. Bloomberg's Sonali Basak is here to explain who's walking away and who's sticking around. Sonali?
Matt, let's put this in context here, because there are regulator crackdowns, investment losses, and widespread withdrawals. The crypto crash of 2022 has caught the eye of researchers at the Chicago Fed, which said this month that the failure of FTX and customer runs from a wide range of crypto platforms formed a classic financial crisis in a novel setting that has raised urgent policy concerns. But don't expect movement too quickly on overarching policies, because over at the SEC, in response to a petition from Coinbase, the largest U.S. crypto exchange, the U.S. regulator told a court that existing securities laws do not create an obligation to issue broad new regulations regarding digital assets. It also said Coinbase's request to have policy addressed immediately doesn't entitle it to extraordinary relief to a rulemaking petition put forward to the SEC. Now, the commission gave examples of where it took years for new SEC rules to be sorted through. The SEC, however, has also brought a flurry of enforcement actions against crypto firms, and that's raising fears over the industry's future and business model. Coinbase, it's expanding its presence abroad, and 2 of the world's biggest crypto market makers are pulling back from trading digital assets in the United States. Both firms are still making markets in crypto, but on a smaller scale than they've previously done, according to a Bloomberg report this month. Mike Novogratz's Galaxy Digital is also moving more operations offshore, partially due to a little bit of stasis, he says, in U.S. laws. That's not to say that financial giants and crypto titans are abandoning the industry, where, as you said, Matt, Bitcoin prices alone have soared more than 60% this year. German asset manager DWS recently linked up with Galaxy to start offering new crypto-linked products in Europe, while U.S. private equity giant Apollo has reportedly been in discussions with NovaWolf as an investor in a bid to buy assets of bankrupt crypto lender Celsius, according to CoinDesk. Now, payments giant Visa has also recently highlighted new work with digital currencies, particularly those linked to central banks. Now, this is all to show that crypto on Wall Street is under pressure, but it's sure not dead.
All right, Sonali Basak, thank you very much. Let's continue this conversation on what is alive or not. Joining us now is Nic Carter, Castle Island Ventures founding partner. Nic, great to have you back on the show. As Sonali is running through some of the players that are pulling back on their operations, or as we've heard often, moving them elsewhere, ultimately, how much realistically can be chalked up to the U.S. regulatory environment? Or is that really just looking at finger pointing and somewhere to blame?
No, I mean, it's extraordinarily challenging. In 10 years of being a market participant, 5 years full-time investing in this industry, I've never seen as challenging a regulatory environment as we have in the U.S. It's full frontal assault through the bank sector. Of course, I think that's been widely discussed, certainly through the securities regulators, the CFTC. Virtually every financial regulator in the U.S. Has acted virtually in unison this year in an attempt to marginalize the crypto space. We see attacks potentially being levied on Bitcoin miners in this country. So every possible conceivable mechanism to push the industry offshore is being explored by the current administration. And the reaction to that has been material. Every major firm that touches crypto is at least looking at other options. And certainly some of the largest ones are now looking to re-domicile abroad, whether that's EU with a new, clear rules of the road in Europe, whether that's a jurisdiction like Bermuda, or whether that's even somewhere like Hong Kong. So, in my career in the crypto space, I've never seen as hostile regulatory posture as we have in the U.S. today.
Well, Nic, on the subject of banking, which you referred to, I just got back from Capitol Hill and the Senate Banking Committee hearing on the failures of Signature Bank and Silicon Valley Bank. And frankly, there wasn't that much conversation around crypto or digital assets. Senator Lummis did ask about it, which probably isn't all too surprising. You had some commentary from Senator Haggerty as well. But by and large, it feels like the pointing the finger at crypto as a reason why these banks failed has kind of fallen out of the narrative. And I'm hearing less about kind of the choke point 2.0. What are you hearing about that?
Well, it's curious because the initial reaction by certain high-profile senators was to blame crypto. And of course, as the run, which was ultimately caused by interest rates rising very quickly, and potentially in conjunction with flighty depositors, as that run continued across banks, many of which had no venture exposure, certainly no crypto exposure whatsoever, it became more tenuous to blame crypto. However, what's colloquially referred to as choke point 2.0, that's still very real. Crypto firms continue to have an extremely hard time getting access to banking, especially transactional or FBO-style accounts. Crypto firms continue to look desperately for banking connectivity, and the major banks, the few outstanding banks that openly service crypto, are under pressure. And there's been other forms of harassment against those banks, like Cross River just recently. So certainly not over. It's just that, it's clear now that crypto wasn't the catalyst for the bank run in the traditional sector. I think that much we know.
Nic, how much has this administration and this Congress clamping down on crypto dried up liquidity in the market? We also just heard from Shanali that, Jane Street and Jump are pulling back. As these firms move out of the U.S. offshore, what does that do to liquidity? Yeah,
we saw headlines around Jump and Jane Street recently. Liquidity conditions have significantly deteriorated in the last month, especially for smaller cap. I think for market makers that are making markets for coins which could potentially be deemed unregistered securities, there's now a lot of concern around maintaining those relationships. Even for the majors, liquidity has deteriorated. Bitcoin and Ether, which I don't think run any risk of being considered securities. One of the main reasons for that is the loss of the SEN network, the SIGNET network, these real-time fiat settlement networks that were administered by these banks that collapsed in March. That's when we saw liquidity really start to dry up. So it has hit the entire market. And that means for a hypothetical large trade, of course, your execution is going to be worse. So it's just much more challenging now for a large institution to deploy into the space. And so, if you look at the metrics, liquidity has, from a mechanical sense, deteriorated dramatically, and the partial exit of these large market makers doesn't help there.
What about other effects on the price, let's say, of Bitcoin, Nic? As the Fed was raising rates, that provided a real return alternative to the cryptocurrency, but now many expect that they'll plateau and hold at this level. At the same time, the bank failures that you mentioned have pushed a lot of people towards cryptocurrency as a form of maybe safer money, kind of the original Bitcoin thesis. What do you make of the price action we've seen thus far?
I think there's a narrative that as the banks fail, Bitcoin gets a tailwind from that. I think what's really happening there, mechanically speaking, is simply that people perceive that there will necessarily be new liquidity injections into the system as the Fed seeks to potentially backstop the banks and shore up the treasury market. And so even if rates hold here, there's other ways that the Fed can inject liquidity into the system. And I think ultimately Bitcoin is a relatively pure gauge of liquidity conditions. And so the relatively strong performance this year for Bitcoin, I think it's simply reflective of the market's anticipation of new injections of liquidity into the system, even if rates hold, especially as financial conditions get really difficult and the Fed is trying to find new facilities. And, whether it's the bank, BTFP, or other ways to shore up the treasury market, I think really that's just what the market is doing and anticipating that re-liquefaction.
Well, Nic, we've heard that obviously the banking failures maybe support the thesis for crypto and decentralization. At the same time, we've heard the same thing or similar things about the debt ceiling and the questioning around the full faith and credit of the United States. That's obviously a conversation that is dominating here in Washington today, has been for some time. Ultimately, what do you think happens to the price of Bitcoin if we get a deal on the debt ceiling? Is that, take part in the risk rally that may result from what's happening in other risk assets, or is that actually detrimental to Bitcoin?
That's a great question. I don't think anybody wants to see an actual default. I think everybody wants to see an agreement reached over the debt ceiling. Bitcoin has decoupled from risk assets, actually, so it's a good question. It's behaving much more like gold than it is behaving like the S&P 500. So good question there. So hard to say, but regardless, I think we are going to see the Fed starting to get much more active in terms of supporting markets, supporting the treasury market in particular. The debt ceiling is an interesting sideshow, but the real story is the significant level of indebtedness, which isn't going away. And that's going to be something government's having to deal with. Many of us think that the one solution to debt to GDP being 125% will ultimately be inflationary. And so I think that'll be supportive to the price of Bitcoin.
Nic, great having you on. Great to get your take. Thanks so much for joining us. Nic Carter there of Castle Island Ventures. Now coming up, we're going to speak with the co-founder of Solana, Raj Gokal.
Looking forward to that conversation. Plus, we'll have more on crypto's governance problem, what a Bloomberg survey of major crypto companies revealed about the lack of guardrails in the sector's top tier.
And to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg. Bloomberg Crypto. I'm Matt Miller in New York with Kaylee Lyons in Washington. Now, we kicked off the show talking about the outperformance of Bitcoin versus some TradFi assets, but really Solana has been an outperformer compared with Bitcoin and Ether year to date. Take a look at the price. It's more than doubled in 2023. However, if you look back over basically a 3-year period since the launch of Solana, it's still worth less than a tenth of the high that it reached in 2021. It was over $260 at that point, whereas Bitcoin has just about halved. Joining us to talk about this is Raj Gokal, co-founder of Solana. Raj, thanks so much for joining us. So this year, there's been a lot of excitement again around Solana. Some of it, I think, maybe due to Bonk, which is a little bit silly, but still fun to talk about. A lot of it due to Saga, which is a new phone that you've come out. Talk to us about what you make of the price action.
Well, I don't really focus on price, but I think the thing that is exciting, as you mentioned, assets like Bonk, also NFTs, these may look like toys to, the casual passerby, but they are stress testing real financial infrastructure that supports very serious use cases like Helium that migrated to Solana from its own blockchain has 1.5 million hotspots around the world that create a decentralized 5G network that's much cheaper for your average user to sign up to. And even new applications like Hivemapper that couldn't exist without Solana's performance. Google APIs for maps are one of the most expensive in the world. And this is a decentralized version of that where drivers are populating it and earning honey tokens through dash cams. So, these toys are kind of the most visible and viral things. They're sort of like the TikTok videos of crypto. But underneath, it's really stress testing the infra.
All right, so in terms of stress testing, we have seen network breakdowns in the past kind of cast a shadow over the asset. We have seen, frustration over congestion, frustration over gas fees. I mean, on the Ethereum blockchain, I think one user paid like $160,000 for one transaction. What are you seeing as the result of these stress tests on your blockchain?
Yeah, so it's important to delineate between, high fees, which for most users could be considered unavailability or an outage. And then, halting of block production. So on Solana, the fees never really go up substantially, nowhere near $156,000, which is that transaction you saw on May 8th. On Solana, it's about $10 for 1 million transactions, and it's always been that way. At this point, most high performance, kind of next generation blockchains have had some outages. Solana in the last 70 days has had 100% uptime, even through multiple of these use cases spiking in parallel. So Solana kind of went through the gauntlet earlier than most. We saw the largest influxes of hundreds of thousands of users concurrently, bots spamming the network, high frequency trading firms really trying to get at these assets and flip them in the last year. And now it's quite battle hardened with things like local fee markets. But we see on networks like Ethereum, they're having their first outages for the first time in the last week. And in the times that they are working, the layer ones are very, very expensive. So, our thesis is that has been a big prohibitive factor in onboarding normal users that maybe just have $100 or $1,000 to play with in crypto. And that's one of the issues we're very focused on solving.
Okay, so that's kind of the average user or the smaller users. I do wonder about your marquee users or clients, because of course we all know about the relationship that did exist between Alameda and FTX and Solana. In the absence of that, who are your marquee clients now? How are you attracting them? Have you had difficulty in that?
I think the network effects of Solana have gotten to a point where, I don't have to have a conversation with really impressive builders, investors, and participants in the financial ecosystem. Nobody at Solana Foundation really needs to. Things like Render, it's a very big established render network that's used in Hollywood for opening scenes of things like Game of Thrones. They have a decentralized network of GPUs and a marketplace for accessing them. And that community voted to move to Solana on its own volition. Same thing with Helium and same thing with builders like Hivemapper. What we see with institutionals is, I think across the whole industry, there's sort of a pullback and a lot of hesitancy, as you guys discussed with Nic Carter earlier. That's something that Solana is not immune to. But this is why the thesis for Solana has always been a focus on, just an order of magnitude or more of a larger user base and what it takes to build a product that, normal people actually can use. And we're seeing that happen now. Solana's got the most daily active addresses of any network at around 500,000, which is still low, but it's consistently high for a blockchain network.
And finally, just looking toward the future, AI is now the buzzword of the year. It seems, how is Solana Labs thinking about artificial intelligence? How do you see this fitting into the future ultimately?
Sure. I think as with most verticals, it's multifaceted. So I mentioned Render earlier. Those latent GPU supplies at people's houses and their computers that are getting activated for the Render network, they can be used not just for render jobs, but for also training and inference on AI networks. Solana Labs also launched a plugin for ChatGPT for accessing the network. This is just another step in making it that much easier to interact with the chain and feel like you're maybe speaking to, an advisor or a co-pilot that's helping you navigate the chain and its assets. I think we're still at very early stages. Some of the most exciting but surprising stuff is what comes out of NFTs. These are brands that have ambitions to become the next Disney or Marvel, and using AI to, populate the characters, the story, the lore, and even generate some of the art. Very early stages, but some of these brands have gone on to sign deals with, Def Jam Records and large studios like Cabanimation. They could be the next Pixars, and it could be all off the back of generative AI.
Raj, thanks so much for joining us. I've learned a lot. Raj Gokal there, the co-founder of Solana, talking to us about his blockchain. Coming up, crypto's governance problems. What a Bloomberg survey of major crypto companies revealed about the lack of guardrails in the sector's top tier. This is Bloomberg. This is Bloomberg Crypto. I'm Matt Miller in New York with Kaylee Lyons in Washington. Now let's get to some of the crypto stories that caught our attention this week. The top 5 of this year's best performing non-leveraged ETFs are all crypto linked, but investors are still hesitant to bite. Despite a rally of over 120%, the Valkyrie Bitcoin Miners ETF has attracted just $12 million of inflows so far this year. That's just a tiny fraction of the $118 billion that have poured into the overall industry.
Well, and crypto asset service providers may have to begin reporting transactions of their EU clients to tax authorities starting in 2026. That's according to a new rule agreed provisionally by EU finance ministers on Tuesday. The European Parliament holds a vote on the opinion on July 10th.
And a Bloomberg survey of 60 major crypto companies across the industry found that many operate outside the norm of traditional corporate governance. Only around half engage an independent auditor to assess their finances, and nearly 2/5 don't have or didn't disclose whether they have an independent board of directors. Many of the surveyed companies also said they had trouble engaging with major auditing firms, due in part to a perceived lack of experience with blockchain accounting. So either they need to get this done, or they're going to have problems going forward if they want to continue to operate in the U.S.
Well, see, this is exactly the point, Matt. This is what so many crypto skeptics or critics point to when they describe that the problems that they have with this industry. Like Congressman Brad Sherman, who we spoke to last week, really has difficulty with the lack of transparency, what you would usually see in companies, and the financial kind of disclosures. It is worth noting, though, that of these 60 companies, only a handful of them are public. So that means you kind of have to do less in terms of disclosure.
I mean, Sherman also compared crypto to cocaine and organ harvesting.
Yeah.
So that was kind of an extreme view. Still interesting. This is Bloomberg.